This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the AIPIS show for accredited income property investment specialists and those who aspire to be. If you're a real estate, mortgage, or financial professional, this is the place for you. We'll explore innovative investment analysis, sales, marketing, and income-generating strategies for the most historically proven wealth creator, income property. Learn from the experts as they show you how to build a better business and a better life.
Welcome to this edition of the Mortgage Minutes. We are once again joined by one of the lenders in our network, and we want to talk today about the rates that you're going to see whenever you go to get your pre-approval and then hopefully get closed on your investment property. So let's have a talk today on this lovely day. What's going on in the mortgage market today?
I guess what we're seeing with regard to the industry in general is underwriting teams and lenders, Fannie Mae and Freddie Mac, are continually asking for a borrower to update their situation or position, and to the degree that, we want to make sure that they haven't lost their job, that they haven't been furloughed from work, or if you're a self-employed borrower, that your position within your employment and your business hasn't changed negatively as a result of any COVID-related concerns. On the flip side, however, the good side of it all is that rates have obviously been as low as we've seen in history, not just modern times, but historically low. So that has led to some COVID-related consequences as well in the industry, such as appraisal and underwriting teams just being completely overwhelmed. Lenders in general are overwhelmed. But the biggest delay that we're seeing really is with the appraisers. They might go out and do the inspection, see the home, view the home, but it might take them a week or longer, or maybe 2 weeks to write up the report.
Wow.
So that's a kind of a related consequence of the overall volume that we're seeing in the industry, because everybody's trying to refinance to lower rates. And all of our borrowers in our network are trying to buy these properties because inventory is kind of low, as you can imagine. Mm-hmm. So there's a demand on the purchase side because of the inventory issue. There's also a huge demand on the refinance side for clients just to lower their payments and or take equity out of their homes to buy more homes. So the whole system is a little strained as a result of rates being low, which is a direct consequence kind of COVID and the recessionary environment that we're in. Having said that, rates are excellent though. Rates are excellent right now. An individual borrower, let's say, who's buying our typical investment property for $120,000, $125,000, with 20% down, that 30-year fixed rate today is going to be, 3.5% with no points. You can get down to maybe 2.75 if you pay a couple of points. A lot of our clients are doing 20% down and paying a point or 2 points to buy the rate down.
Yeah. What's the lowest you've gotten?
25% into the deal. The lowest I've seen with 25% down is 2 3/4 with no points. But conversely, if you're doing 20% down and you just pay a point or two, let's say you pay 2 points and you get down to 2.75, then you're putting 20% plus 2% on the loan amount into the deal, as opposed to 25% equity into the deal and getting the same interest rate.
Yeah. Yeah, it's definitely worth running the numbers.
What I tell a lot of folks is, exactly, run the numbers, but I tell a lot of folks, if you were to pay 20% down and take the rate at 3.5 or even 3.75 and then wait for the market to improve again, you may never get down to 2.75, but even if you did, the cost of a refinance is much more expensive than just paying the point or 2 points to buy the rate down today. So it's almost worth the investment today when you're buying your home, because you'll never touch that rate ever again.
Yeah, I was wondering, with the massive increase that you were talking about that we've seen, with refinances and mortgage starts, how long is the pre-approval process taking? Because, everybody's slammed and backed up. How long is that taking right now?
Well, refis are definitely taking longer because the purchase market with every lender, it doesn't matter who you are, every lender is going to prioritize a purchase deal over a refinance deal. So again, as it relates to the appraisals and the timeline anticipated around an appraisal being done, I would say we're in between 30 and 45 days to close a loan if the house is already appraisal ready or maybe even tenant occupied. Now, pre-COVID, that would have been 3 weeks to 30 days to do that loan. So we are allowing for a week or a 10-day extension on just getting the appraisal completed. Our execution as it relates to underwriting and documenting and collecting what we need from the borrower is pretty much the same. So our outlier here is just the appraisal turn time.
Okay, so pre-approval still just a couple days?
Yeah. From an underwriting perspective, we're 24 to 48 hours to get a decision.
Okay.
So that's not changed really at all with the volume, simply because we're managing that internally as a company and we're staffing up as we need to for the volume. So, but on the refinance side, you'll certainly see that's a delayed process. You know, it might take an underwriter a week to underwrite a refinance file, whereas pre-COVID, that would have been done in that 24 to 48 hours time, only because, again, the purchases are going to take precedence over the refinance transactions.
So one of the things that a lot of people have been talking to me about is forbearance right now. And there's some people who went into it strategically. There's some people who went into it because they needed it. And, now they potentially could come out, but they're kind of biding their time. What is the current rules about coming out of forbearance and then getting an investment property loan?
Well, as it relates, anything that we see, every company might be a little bit different. And certainly some big servicers, some big banks like Wells Fargo, B of A, the big guys might have different internal forbearance guidelines. So in other words, if your loan is with Wells Fargo and you want to refinance that loan with Wells Fargo, but it's in forbearance, they may have some alleviated guidelines there. As it relates to Fannie Mae and Freddie Mac, with our buyers who are buying investment properties, to qualify for a new loan, if you're in forbearance on any other property that you might own, you have to get current on that forbearance. Okay. So if you've taken forbearance for 90 days, one way or the other in the past, but that 90-day forbearance is expired or up and you wanted to extend your forbearance, we're going to require that you come out of forbearance and you get current on that mortgage. Mm-hmm. So you got to think about it this way in practical terms. Is like, okay, if you're asking us to lend you more money to buy another investment property, but one of your other investment properties is in forbearance because you strategically took forbearance because, or you had to take forbearance because your tenant wasn't paying you, why would a lender lend more money on a loan and know the history of a loan that's not being paid on time? You know what I mean? So they're going to want to make sure that you pay the loan that's in forbearance to the current level before they'll extend more credit to you.
Yeah. So pretty much as soon as you're caught up on everything, you're good to go?
Yeah. I mean, I can document that while we're processing the loan too. It's just we sometimes don't even find out that the borrower's in forbearance until we pull credit, so we've already pretty much gone down the garden path. And then we find out about the forbearance. So that's when we have the conversation about getting current.
So with the rates being as low as they currently are, what are you seeing? You talked a minute ago about the refinance market and kind of paying down points now because you're not going to be able to refinance. What do you see happening in 5, 6, 7 years when people would usually refinance? Are we just going to see a whole lot of HELOCs coming on board, or what are these low rates going to do to the refi market in the future, do you think?
Well, I think any refi market is cyclical. So, for example, we're as low as we are now as it relates to COVID and the recessionary environment that we're in, COVID-related recession, right? I think in 3-4 years' time, we might see a more normal rate market where rates will go back up. They don't really have any place to go but up, right? So in 3 years' time, they might go back up, but then you'll start that cycle of acquisition again, right? And then 6 years from now, 7 years from now, you might see another recessionary environment where rates come back down. And those folks that had purchased in 2 years' time at, let's say, 4.5% or 4% might get a chance to refinance. So the nature of the industry is very cyclical.
Right.
The average length of time that a loan is on a lender's books is probably 5 years, 3 to 5 years these days. Those folks that purchased from us earlier in the year and finance loans from us late last year and earlier this year, pre-COVID, are now refinancing, right? So I'm seeing a lot of customers that closed on loans in March and April of this year, and they're now, and they were at a higher interest rate environment, and now they're trying to refinance that debt.
Yeah, but
because rates are so low.
But I mean, the ones who come in and are getting the, 3.25%, 3.5%, are you expecting those loans to stay on the books longer since they are so low?
Yeah. I don't expect what we call churning. That's not going to churn.
Yeah.
Those rates are so historically low that you're set it and forget it. Or if you paid a point to buy the rate down to 2.99 or whatever the case may be, you're making that investment now to buy that rate to the lowest bid in history, and you truly can just set it and forget it. Unless you want to take cash out of a property, that's the only way you would refinance off of that low interest rate.
Yeah.
So yeah, I definitely anticipate rates that folks that are taking these rates today to literally set it and forget it.
Yeah. I mean, there's not much reason not to until
That's a 30-year fixed rate. Yeah. So, I mean, there's no stress or no pressure on you to do anything with that market rate, so, but certainly we're seeing a lot of folks take advantage of the market. Yeah.
All right. Well, is there anything else going on in the mortgage industry and the rates that you think people should know?
I mean, I would just say have patience, because the process, like I said, everybody's overwhelmed. Our processing team certainly had challenges this year, personnel-wise. People get burned out, and just I personally on our team, we had 2 or 3 members just quit. They just resigned because of the overwhelming volume and the stress that creates. So I would just say have patience with us, and we'll get it done. So that's the only thing folks kind of need to be aware of as it relates to the volume, because we all want it when we want it, and we want it done quickly, of course, but at some point, there's a strain on the system that needs to be acknowledged.
And that will do it for this month's edition of the Mortgage Minutes. Everybody, if you haven't started talking to us about your investment properties now, go to jasonhartman.com, fill out any form there, and we will get back to you and start helping you with that. If you have an investment counselor, such as myself, reach out to us now. Let's start talking properties and getting your portfolio going.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.